In this video, I'll show you one of my favorite swing trading strategies, the trendline pullback strategy. This strategy is simple to learn, works on Forex, stocks, indices, cryptocurrencies, and commodities, and helps you enter high-probability trades by joining an existing trend instead of chasing the market. Before we get started, let me show you what you'll learn in this video. How to trade one of my favorite swing trading strategies from start to finish. The exact entry, stop loss, and take profit rules I use. The 4 mistakes that can ruin this swing trading strategy. A simple checklist to identify high-probability trading setups. How to apply this swing trading strategy using real chart examples. Before we dive in, if you enjoy videos like this, don't forget to like this video, subscribe to the channel, and turn on the notification bell so you never miss a new trading strategy and other price action tutorials. Now, let's get started. The trendline pullback strategy is a trend-following strategy that allows you to buy or sell after a temporary pullback instead of entering after the market has already made a large move. Instead of chasing the trend, you wait for price to retrace toward a well-respected trend line and then look for a candlestick confirmation that buyers or sellers are stepping back into the market. By entering after the pullback, you can often achieve a better entry price, a tighter stop loss, and a higher risk-to-reward ratio than traders who enter during the initial breakout. So, why does this strategy work? Financial markets don't move in a straight line. During an uptrend, buyers push prices higher before taking profits, causing temporary pullbacks. If the overall trend remains strong, new buyers often step in during these pullbacks, creating another impulsive move higher. The opposite happens during a downtrend. Sellers drive prices lower, a temporary rally follows, and then selling pressure returns, pushing prices down again. The trendline pullback strategy is designed to take advantage of these temporary retracements and join the prevailing trend at a better price. Now, let's look at the exact trading rules. The first step is to identify a clear uptrend or downtrend. In an uptrend, the market should be making higher highs and higher lows. In a downtrend, it should be making lower highs and lower lows. Avoid markets that are moving sideways because trendline strategies perform best in trending conditions. The second step is to draw a valid trend line. Once you've identified the trend, draw a trend line by connecting the swing lows in an uptrend or the swing highs in a downtrend. Your trend line should connect at least 2 significant swing points without forcing the line to fit the price. The more times the market respects the trend line, the more reliable it becomes. The third step is to wait for the pullback. Never chase the market after a strong, impulsive move. Instead, wait patiently for price to retrace back to the trend line. This allows you to enter the trend at a better price while keeping your stop loss relatively small. The fourth step is to wait for a confirmation candle. When price reaches the trend line, don't enter immediately. Wait for a bullish confirmation candle in an uptrend or a bearish confirmation candle in a downtrend. Examples include a bullish or bearish engulfing pattern, a hammer, a shooting star, or a bullish or bearish pin bar. These candlestick patterns suggest that the pullback may be ending and that the main trend is ready to resume. Enter the trade when the confirmation candle closes. Waiting for the candle to close helps reduce false signals and confirms that buyers or sellers have regained control. For long trades, place your stop loss below the most recent swing low. For short trades, place it above the most recent swing high. This gives the trade enough room to fluctuate while protecting your capital if the trend reverses. You can set your take profit at the next major support or resistance level. Alternatively, you can trail your stop loss as the trend develops to capture larger moves. Now that you understand the complete strategy, let's look at some real chart examples to see how it works in different market conditions. This is the British pound versus the Japanese yen on the daily chart. As you can see, the market is in a strong uptrend. We draw a trend line by connecting the swing lows. Here's the first touch, and here's the second touch. Now let's see what happens next. Price starts pulling back toward the trend line, and as soon as it reaches it, buyers step in and reject lower prices, forming a bullish pin bar. This is our confirmation candle. We enter the trade at the close of the pin bar, place our stop loss below the recent swing low, and set our take profit at the next major resistance level. Now look at what happens. As expected, the market resumes the uptrend and eventually reaches our target. One of the biggest advantages of this strategy is that you don't have to spend hours watching the charts. Since we're trading on the daily time frame, all you need to do is open your charts after the New York session closes, spend 15 to 20 minutes scanning for setups, and see if a trendline pullback has formed. If you find a valid setup, simply place your entry, stop loss, and take profit. Then walk away and let the market do the work. Let's look at another chart example. This is the British pound versus the US dollar on the daily chart. As you can see, the market makes an impulsive move higher, followed by a pullback, and then another impulsive move. This sequence of higher highs and higher lows confirms that the market is in a clear uptrend. Now let's draw our trend line by connecting the swing lows. Here is the first touch, and here is the second touch. Let's see what happens next. Price retraces back toward the trend line, and as soon as it reaches it, buyers reject lower prices, forming a doji candlestick pattern. This rejection suggests that selling pressure is fading and that the pullback may be coming to an end. We enter the trade at the close of the doji candle, place our stop loss slightly below its low, and set our take profit at the next major resistance level. Now look at what happens. As you can see, the market resumes the uptrend and reaches our target as expected. Now let's look at a bearish example. This is the US dollar versus the Swiss franc on the daily chart. As you can see, the market makes an impulsive move lower, followed by a pullback, then another impulsive move lower. This sequence of lower highs and lower lows confirms that the market is in a clear downtrend. Now let's draw our trend line by connecting the swing highs. Here is the first touch, and here is the second touch. Now look at what happens next. Price retraces back toward the trend line and gets rejected, forming a long-tailed bearish rejection candle. This rejection suggests that buyers are losing momentum and that sellers may be ready to take control again. We enter the trade at the close of the rejection candle, place our stop loss just above its high, and set our take profit at the next major support level. Now look at what happens. As you can see, the market resumes the downtrend and reaches our target as expected. Now let's look at another chart example. This is the euro versus the US dollar on the daily chart. As you can see, the market makes an impulsive move lower, followed by a pullback, and then another impulsive move lower. This confirms that the market is in a clear downtrend. Now let's draw our trend line by connecting the swing highs. Here is the first touch, and here is the second touch. Now let's see what happens next. Price retraces back toward the trend line, gets rejected, and forms a clear bearish engulfing pattern. This is our confirmation to enter the trade. We enter the trade at the close of the bearish engulfing candle, place our stop loss above the recent swing high, and set our take profit at the next major support level. Now look at what happens. As you can see, the market resumes the downtrend and reaches our target as expected. Now, let me tell you something important. If two traders use exactly the same trendline pullback strategy, one of them may consistently make money while the other keeps losing. So, what's the difference? The difference isn't the strategy, it's how they execute it. The profitable trader avoids a few critical mistakes that most beginners make, while the losing trader repeats them over and over again. Let's look at the 4 mistakes that can completely ruin this strategy. One of the biggest mistakes beginners make is forcing a trend line to fit the price. As you can see here, we have a clear uptrend. This is the first touch, and this is the second touch. By connecting these two swing lows, we get a valid trend line. The mistake many traders make is trying to force the trend line to connect the third touch. As you can see, doing so changes the angle of the trend line and causes it to ignore the previous swing lows that the market clearly respected. Remember, the market defines the trend line, not you. If you have to keep adjusting the line just to make it fit every new swing, it's probably not a valid trend line. If there isn't a clear and obvious trend line, simply move on to another chart. There will always be another trading opportunity. Another common mistake is entering the trade as soon as price touches the trend line. Just because the market reaches the trend line doesn't mean it will respect it. Sometimes, price breaks straight through the trend line and continues moving against you. That's why you should always wait for a confirmation candle before entering the trade. As you can see on this chart, price pulls back to the trend line, but instead of buying immediately, we wait for a bullish confirmation candle. Once the confirmation candle closes, we enter the trade with much greater confidence that buyers have stepped back into the market. The same principle applies to bearish setups. Wait for a bearish confirmation candle before entering a sell trade. Being patient for a single candle can be the difference between entering a high-probability trade and getting caught in a false move. Waiting for confirmation won't eliminate losing trades, but it can help you avoid many unnecessary ones. Another mistake many traders make is looking only at the daily chart and ignoring the bigger picture. Before taking any trade on the daily time frame, always check the weekly chart first. Look at this chart example. As you can see, the market is in a steady uptrend, and we have a valid trend line. This is the first touch, this is the second touch, and this is the third touch. When price reaches the trend line for the third time, it forms a bullish pin bar, suggesting that the pullback may be over and that buyers are stepping back into the market. But before entering the trade, let's switch to the weekly chart. As you can see, the weekly chart is also bullish. Price has pulled back to this trend line and formed a strong bullish rejection candle, indicating that buyers are still in control on the higher time frame. This means the weekly trend is aligned with our daily setup, increasing the probability of a successful trade. Now let's switch back to the daily chart. We enter the trade at the close of the bullish pin bar, place our stop loss below the recent swing low, and set our take profit at the next major resistance level. As you can see, the market moves higher and reaches our target. If the weekly chart had been in a clear downtrend or approaching a major weekly resistance level, it would have been better to skip this trade and wait for a setup where both timeframes are aligned. Now that you know how to trade this strategy and the mistakes to avoid, let me show you a simple checklist that can dramatically improve your trade selection. Before taking any trendline pullback trade, I always go through these 6 questions. First, is the market in a strong trend? The market should be making clear higher highs and higher lows for an uptrend, or lower highs and lower lows for a downtrend. Second, is the trend line valid? It should connect at least 2 clear swing points without forcing the line to fit the price. Third, has price made a clean pullback to the trend line? Never chase the market after a strong impulsive move. Be patient and let price come to you. Fourth, does the weekly chart support the trade? Always perform a top-down analysis before entering a position. Ideally, the weekly time frame should be aligned with your daily setup and should not be approaching a major support or resistance level. Fifth, do you have a strong confirmation candle? Wait for a bullish or bearish engulfing pattern, a pin bar, a hammer, or another clear rejection candle before entering the trade. Finally, is there enough room to your target? Make sure there's enough distance to the next major support or resistance level. If the potential reward doesn't justify the risk, simply skip the trade. If you can answer yes to all 6 questions, you've found a high probability setup. If even one answer is no, stay patient and wait for the next opportunity. Remember, successful traders don't take every trade, they only take the best ones. Now, let's put everything together with one final chart example. The first question I ask myself is the market in a strong trend? As you can see, the market is making a series of higher highs and higher lows, so the answer is yes. Next, is the trend line valid? We connect these 2 clear swing lows, and as you can see, the market has respected this trend line multiple times without forcing it to fit the price. Now, has price made a clean pullback to the trend line? Yes. After a strong impulsive move, the market retraces back to the trend line, giving us the opportunity to join the trend at a better price. The fourth question is, does the weekly chart support the trade? Let's switch to the weekly time frame. As you can see, the weekly chart is also bullish and isn't approaching a major resistance level. This tells us that the higher time frame is aligned with our daily setup. Now let's switch back to the daily chart. The fifth question is, do we have a strong confirmation candle? Yes. As soon as price reaches the trend line, it forms a bullish engulfing pattern, confirming that buyers are stepping back into the market. Finally, is there enough room to the next resistance level? Yes. The potential reward is much greater than the amount we're risking, giving us a favorable risk-to-reward ratio. Since every item on our checklist has been confirmed, this is a high probability setup. We enter the trade at the close of the bullish engulfing candle, place our stop loss below the recent swing low, and set our take profit at the next major resistance level. Now look at what happens. As you can see, the market resumes the uptrend and reaches our target. This is exactly how I analyze every trendline pullback setup. I don't take trades based on emotions or guesswork. I simply follow the same checklist every time and only enter the market when all conditions are met. That brings us to the end of this video. If you found it helpful, don't forget to like this video, subscribe to the channel, and turn on the notification bell so you never miss a new trading strategy. Thanks for watching, and I'll see you in the next video.